Good evening, everyone, and thank you for joining us for Q3 FY21 earnings conference call. I hope all of you would have received a copy of our results presentation. I would like to urge you to go through this along with the disclaimer slides. Today we have with us Mr. Amit Agarwal, Group CFO, Mr. Joe Kuruvilla, CEO of Lifestyle Business, Mr. Ganesh Kumar, Chief Operating Officer, Lifestyle Business, Mr. S.L. Pokharna, President, Commercial. I will now hand over the call to our Group CFO, Amit, who will give the summary of the results before we open up for Q&A. Over to you, Amit.
Thank you, Mukund. Good evening, ladies and gentlemen. Thank you for joining us today on this earnings call to discuss our results for third quarter of fiscal 2020. Let me give you an overview of the market. During the quarter, overall consumer sentiment improved post Unlock 5 and 6. From October onwards, with normalcy restoration, allowed community gatherings and weddings. We witnessed higher recovery levels in the tier 4 to 6 market, largely driven by reverse migration, good harvest, and lower COVID-19 impact. The demand was driven by festive and wedding season in the months of October and November. Besides the festival season of Navratri and Diwali, there were higher number of marriages in November as lot of summer marriage events happening in June quarter had been postponed to November winter wedding season due to lockdown. In the month of December, the secondary sales were lower due to fewer walk-ins as certain restrictions on travel and mall timings continued, which could be partly offset by the early launch of end-of-season sale, so-called EOSS. Now let me take you through the key financial highlights for the quarter. Our third fiscal quarter of FY21, revenue saw a recovery across all businesses with our top line at 1,286 crores, a recovery of 68% over the previous year. On a sequential quarter-on-quarter basis, the top line has grown by 76% from 732 crores in the second quarter of fiscal 21 to 1,286 crores in the third quarter of fiscal 21. The cost rationalization continued, which enabled us to improve our Ebitda margins to 12.2%, which is marginally higher than the previous year level of 11.8%. We reported an Ebitda of 157 crores and a net profit of 22 crores for the quarter. Our continued focus on efficient working capital management led to further reduction in net working capital by 169 crores vis-a-vis September 20 levels. Free cash flow from operations as well as release from working capital management helped to reduce our net debt by 234 crores compared to September 20. Now let me elaborate on each of the points. Revenue recovered by 68% over the previous year. The branded textile segment recovered by 70%, led by festivity and wedding season, while in branded apparel, the recovery was lower, mainly due to controlled primary sales to channel partners. In the garmenting business, the revenue was well contributed by PPE products. However, in bulk business, certain sales orders were deferred due to fresh lockdowns in the US and Europe. Our engineering businesses are fully back on track, with auto components having a strong 44% growth over a previous year, and a tools and hardware business is in line with the previous year levels. Now, let me talk about the Ebitda and profitability, where we reported an Ebitda of 157 crores with Ebitda margin of 12.2%, driven by our continued efforts on the cost rationalization and various cost control measures in the area of sales, marketing, manpower, rental, and others, coupled with obviously the top line recovery. In Q3, our operating costs stood at 334 crores, which is 42% lower on year-on-year basis. This includes fixed costs, which continued to be maintained at quarter-on-quarter level, and variable costs was lower, mainly due to controlled advertisement and sales promotion spend. From a 9-month performance perspective, the OPEX was lower by 743 crores, which is 45% lower on year-on-year basis. Additionally, the rent cost savings for the full year is 64 crores at about 35% of the previous year level. This has been achieved through an adoption of a collaborative approach with landlords, mainly through combination of rent waivers during lockdown as well as realigning the rentals. Also, as already stated, our store rationalization is in progress to make retail, mainly the EBO portfolio, very healthy. Net store closure is 18 for the third fiscal quarter of 21 and 79 for the 9-month fiscal 21, taking our retail network to 1,559 stores as on 31st of December 2020. During the current pandemic time, healthier liquidity is essential for the business, and we have been able to maintain about 600 crore of cash and cash equivalents throughout the period while reducing the debt at the same time. The company continues its focus on cost reduction and working capital management, which resulted in positive free cash flow and a positive operating cash flow during the quarter. Our operating cash flow was 277 crores and free cash flow was 222 crores in third quarter of fiscal 21. With reduction in inventory and strong collections during the quarter, net working capital stood at 1,190 crores, which is 169 crores lower as compared to September and lower by 665 as compared to March 2020. With these above initiatives, our gross debt was also lower at 2,191 crores vis-a-vis 2,409 crores as at end of September and 2,430 crores as at end of March 2020. The average interest cost is 8.55%, very similar to September levels. Also, our net debt reduced by 234 crores, with our net debt standing as of 31st of December 2020 at 1,583 crores compared to 1,817 crores in September and 1,859 crores in March 2020. Now let me talk about the various segments in retail. About the branded textile, this segment witnessed a recovery of 70% in the third quarter, led by primarily from the domestic market pickup in the wholesale and trade channels on account of festivities and wedding season. The secondary sales in our pan-India 630 town spread TRS, so-called the Raymond shop network, also has shown significant improvement, with recovery clocking to close to 80% in the quarter. However, the recovery was lower in exports due to lower demand on account of second wave of lockdown in US and Europe markets, where customers deferred their dispatch schedule. Overall, suiting segment in domestic market recovered at 80% levels compared to the previous year. The B2C shirting business recovery has been slightly lower at the level of 60%. Overall, the Ebitda margin for this segment for the quarter has been 16.9%, driven by operational efficiency. Let me talk about now the branded apparel segment, where the sales stood at 211 crores, witnessed recovery led by festive and marriage demand in October and November in the retail channels of the EBOs and LFS. However, in December month, secondary sales were impacted due to lower walk-ins as certain restrictions on travel and mall timings continued. On our trade channels of MBO and TRS, we have been prudent on our primary sales to channel partners to support them in liquidating the inventory and speeding up their collections. Overall, from margins perspective, EBITDA margin for the quarter was 3%. While we have been able to bring in OPEX reduction, however, the EBITDA margin was lower on account of higher discounting, controlled primary sales, and adverse channel mix in terms of online and clearance sales. The primary focus in this business has been on the working capital management, and with the measures that we have taken, we have been able to achieve 35% reduction in net working capital from March 20 to December 20, mainly led by inventory reduction. In terms of our wide reach on the retail network, as on 31st of December 2020, we had 1,559 stores spread across 630 towns. We are providing safe shopping experience and processes adopted during peak of COVID time for healthy and safety of our customers and employees. 100% of our retail network is operational, complying with stringent safety guidelines, including contactless payments. As already explained, while we are strongly focused on making our EBO portfolio healthy, at the same time, we are continuously evaluating opportunities where we can improve our retail store footprint. And on the same basis, during the quarter, Raymond added 19 stores, mainly in Tier 3 to Tier 6 towns. In terms of the garmenting segment, the sales stood at 137 crore, witnessed a recovery of 57%. Revenue includes contribution from PPE sales and in bulk business. Customers in US and Europe placed orders. However, due to fresh lockdown, there have been deferment of some orders. Ebitda margin for the quarter was 6.6%. High value cotton shirting segment sales was at 86 crore, witnessing a recovery of 51%, mainly led by higher yarn sales. However, fabric performance was impacted due to lower demand in the domestic market. Ebitda margin for the quarter was at 14.7%. Tools and hardware segment sales was at 104 crore, back to the previous year's level, led by growth in domestic market and well supported by export market. Ebitda margin improved over 20% compared to 12.9% in the previous year, mainly led by operational efficiency. In terms of the auto component segment, sales were at 59 crore, reporting a growth of 44% over the previous year, led by strong growth in domestic as well as exports market. Ebitda margin improved to 24.3% compared to 14.6% in previous year, mainly led by improved plant utilization as well as operational efficiency. Real estate business has recorded one of the strongest quarterly bookings in the third quarter since the launch of the project. Factors such as stamp duty reduction, low home interest rate, and launch of new towers during festivity period of October and November have helped improve sales in the quarter. Overall, we have made now 179 bookings in the third quarter, resulting in a total of 1,173 bookings, which is 50% of the total inventory made available of 2,350 has been sold. So, still with a booking value of 1,121 crores. During this pandemic period, certain customers have faced temporary challenges due to various reasons, resulting in cancellation of booking of certain flats. We have been able to retain most of them through the bank subvention scheme and converting 2 BHK bookings into 1 BHK booking. However, there has been some cancellation. Our construction is on full swing, and currently the status is we are completing the work on the 26th slab in the tower 1, 2, 3, and 7th floor slab is in progress in tower 4, and excavation has been completed and foundation work in the tower 5, 6, 7, 8. Let me update you about the demerger. Demerger has been an important step for the group. We have received approval from stock exchanges and already filed application with NCLT. Due to COVID-19 pandemic and related lockdowns, the entire business environment and processes, including regulatory approval, have been impacted due to temporary closure of business offices and government departments. We expect the overall process to be completed in next financial year. As and when we have a meaningful update, we will inform accordingly. Now, let me talk about how we are seeing the ensuing quarters. In terms of improvement in the consumer sentiment, coupled with continued government measures, including progressive union budget, which is focused on infrastructure development and health sectors with more disposable income, we believe it would boost or provide an impetus to consumer spending and accelerate economic activity. Additionally, from primary sales perspective, we expect traction in trade channels driven by higher number of wedding days in the coming quarters of the next fiscal year. From an input cost perspective, in branded textile segments, the wool prices have remained stable at low levels for the last 6 months, and we expect improvement in our overall performance in this segment. In our B2B shirting business, there has been an increase in the cotton yarn prices. However, we expect to largely offset through a combination of internal cost efficiencies and small price increase. Let me cover the export segment. While the global demand had been progressively recovering till the second quarter of fiscal 21, however, due to the second wave of COVID-19, there have been lockdowns in the US and European markets, which has resulted into deferment of certain orders in our garmenting business. We are closely monitoring the situation and would do the shipments as soon as the situation improves. In our engineering business, we continue to expect good traction from both domestic as well as export markets. With cost optimization measures already undertaken, which is expected to reduce our costs by 30 to 33% on a full year basis, and a focused working capital management and lower capex, we continue to maintain and expect to maintain adequate liquidity. With the various initiatives undertaken, the restructuring of the business will bring in better efficiencies for sustainable growth and profitability. Thank you very much. Now we will be taking the questions. Operator.
Thank you very much, sir. Ladies and gentlemen, we will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Anyone who has a question may press star and 1. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Our first question is from the line of Qtr3 from Sundaram Mutual Fund. Please go ahead.
Thanks a lot for the opportunity and congratulations for an improved show. So my first question is with regard to our realty division. Despite revenue recognition picking up, our margins still continue to be low despite the land being bought at a very low, historical low cost. So when do we see the margin coming to a normal rate of whatever we had expected? That's the first question from my side. And second thing, what is the launch plan and what is the sales run rate we are targeting in the upcoming project, in the realty project?
Okay. So first of all, if you see, since realty division, as you rightly pointed out, it is based on a percentage of completion methodology. We book the accounting. And as we continue to see a stronger development coming and the faster progress on the project, as we outlined, that now we are achieving good level and faster construct, as well as the good traction, the sales velocity is improving. Over the next few quarters, you would see an improvement in the margins because it is just the mathematics, the accounting norms, which enables us to account for in this basis. Now, going forward on your second question, we have been seeing a very good traction on our project. As you would witness that in the Thane region, this location could not have been better. Any location could not be better than this. We have reflected based on the 179 bookings made during the quarter, which shows the people's conviction about this project with the level of amenities in the affordable housing which we are providing. That is purely the testimony in terms of, and it is not that the bookings have shown a drop in the month of January and February. We continue to be higher. We continue to see a good level of bookings, very similar the way we saw in the third quarter. So I think in our project, the progress is very good. And if I look at it on your total inventory which has been launched, if 50% has been already booked, that reflects upon that the project has gained the right traction.
So when further launches will take place, sir?
So, we have already launched 8 towers as we speak, and we have another 2 towers to launch. So we are planning to launch in the next few months. You see, as we say, there is a certain inventory, and in this business, one has to calibrate the inventory and the launches. So in the last 2 years, we have launched 8 towers. 2 towers are remaining to be launched, which we will also launch, let's say, in the next few months.
EBITDA margin, when we should expect improvement, and what is the level of EBITDA margin we should expect?
So we would not like to comment about the EBITDA margin per se. And as I mentioned, the activity in terms of the construction phase has begun, which will enable us to do the accounting of revenues on a percentage of completion method in the next few months. So that will enable us to record better revenues as well as a better margin.
See, I'm Pokarna. I look after real estate business as well. Yes. Just want to add, in September end, we will be launching premium segment flats also, 3 BHK and 4 BHK.
Okay. Sir, then with regards to debt reduction, how much debt reduction furthermore we can see, sir, from the
Yeah, the focus of the group has been very clear that whatever be the cash flow generation has been primarily deployed for a debt reduction. If you see during the pandemic period, the company has been consistently able to maintain a cash balance around the 600 mark, as well as did not take any additional debt. And in this recent quarter, we have been able to reduce the debt. So that is clearly the methodology that we are going to follow. And I can tell you that whatever be the cash flow generations with our tight cost rationalization and working capital management, we will be using it towards debt reduction.
Why we are keeping such a large cash? We will be having sanctioned limits, right? Instead, we can go ahead and pay to the bank itself. We would be earning, instead of we would be paying to bank 10% or whatever the rate, and we would be earning about 5-6% only. So that would be creating a loss of treasury income.
So I'll tell you, what has happened is, as a philosophy of the group, what we have been doing is consistently, we have been maintaining a certain cash balances. If you see, our cost of borrowing is in the range of 8.5%. So there is a small negative carry, but it provides an additional comfort in terms of these pandemic times where you need to keep adequate cash balance for any kind of unforeseen circumstances. Therefore, it is appropriate for us as a business, as a policy that we keep, and we are not going to increase it to 1,000 crores or so. And that is exactly reflected that even in this quarter, we maintained the cash balances of around 600 crore, and what is beyond that, we have gone down and paid down the debt of 233 crores in the quarter.
Sir, how is January progressing, sir? Any improvement are we seeing from the December run rate, or anything you want to highlight on the January progress? Or is it getting weaker just that because the festivals have gone up, completed? So how will you see the January going and the time side?
So look, Raymond is a conglomerate. You have different businesses, and every business will charge their own path. So in terms of my suitings business, the whole thing is that the weddings dramatically have been not there in the summer period. Now, people had some weddings with certain restrictions in the third quarter, maybe November, December. Now, a large part of the weddings is expected going forward in the first fiscal quarter. And if I recall right, there are fairly large number of wedding dates in the first quarter. So then our stockists, our wholesalers are building up their inventory as we speak today in order to cater to such increased demand. So clearly, the suitings market is going to be very, very strong. Now, if I come back to the shirting, we have seen also that there is an adequate pickup happening. So if I look at it in the branded textile segment, we are seeing a very good recovery. If I look at the apparel segment, obviously there are certain challenges faced in that segment because still the stores in the tier 1 and tier 2 cities, people are a bit hesitant to go out, go to the cinema theaters, go to the shopping malls, and if one goes to that places, then he picks up a shirt or a trouser pair. So that's a little bit slower recovery vis-a-vis other products. In my engineering and auto business, as I mentioned, we have seen a full-fledged recovery. On the real estate business, as I mentioned, we are seeing exactly the same traction level as we saw in the third quarter, in spite of an increase in the stamp duty by 1%. But since there is a demand, and the beauty of our project is that it is in the affordable 1 BHK, 2 BHK. So it is the real user. We don't have an investor community coming into this project. It is more the user. So therefore, people in the pandemic have realized, and I'm sure you know, that we remodeled some of our apartments and provided a balcony. So we are very much in tune with the likes of the customer, the demand pattern, the behavior of the customer. We realized that clearly there was an ask from a lot of customers that we would need a balcony. Even in a 2 BHK, we have been able to provide a balcony which enables them a greater comfortable living.
Mr. Jain, I'm sorry,
would
you have to return to the question.
Yeah.
Thank you. Ladies and gentlemen, we would request you to please limit your questions to 2 per participant. Time permitting, you may come back in the queue for a follow-up question. Our next question is from the line of Harsh Shah from Dimensional Securities. Please go ahead.
Yeah, good afternoon, sir.
Good afternoon.
Yeah, so my first question is a follow-up on the previous participant's question on real estate. So would you be able to provide numbers in terms of what is the construction cost per square feet that we are incurring on our project?
So see, look, these are some of the factors which are the basics, the way we have articulated and we manage our business. So it would be very difficult for us to go into the specifics of giving a construction cost. And these are some of our unique ways. We have brought in certain efficiencies. I can only give you that perspective that we have been able to cast a floor in a period less than 7 days, 5 to 6 days, which we know in the industry there has been a very different, a much higher number. So a lot of efficiencies we are putting into the project. We have brought some experts who are providing a greater insight how to improvise into the project so that benefits are getting built into the project.
So when you say that you follow percentage
Mr. Shah, sorry to interrupt. If you're on a hands-free mode, could you switch it to handset because your volume seems to be very low while you're speaking.
Now is it better?
A little better, sir.
Yeah. So when you say that you follow percentage of completion method and going ahead as you book more revenue, so is it that the margins will move disproportionately? That is, lower and lower costs will be recognized going forward, but revenue will be more and more. Is that what you mean?
So look, we have given clearly the guidance of profit after tax of 25% on the overall project post completion of this project. So we stick to that, and the margins we will deliver a 25% margin across the project over the next 5 years.
Okay. And in terms of business, so how is the inventory in the system moving? Last time when we spoke, you had some 1,700 crore worth of inventory. So where do we stand in terms of inventory, and are we expecting any write-offs there? And also in terms of debtors, if you can throw some numbers as to are we seeing any concerns there, or everything is under control?
So look, we have told very clearly that my net working capital stood at 1,190 crores, which is lower compared to March by 665 crores. So clearly we have worked on our inventory, which enabled us to get the sales, and therefore I look at it that this inventory debtor collection is our task, which we are completing as we speak. Our focus has been phenomenal in this working capital reduction. So and I said, the true value in this is we have been able to reduce the debt compared to March. If I look at it from an 1,859 crores of net debt to 1,583 crores, realizing to 275 crore debt reduction. This is coming out of the working capital management.
Okay. Hello.
Yeah. Go ahead, please.
Yeah. So just last question. It's again a follow-up. So you had paid some 170 crore of ULC fees on, I think, conversion of your land from to make it commercialize your land basically. So how much of that is attributable to the real estate project that you are working on?
That is about 20%. 28%.
Sorry, can you come again?
Yeah, so basically what we are saying is this is for the entire larger piece of the land. So if for 20 acres, it would be in the range of, I think if I recall it right, around the 40 crores kind of a number. If I recall, that would be the number for relevant for the affordable housing project.
And have we expensed it entirely, or we are doing it on percentage of completion?
Yeah, percentage of completion, because that's a methodology laid out as per the accounting standards.
Okay, understood. Thank you. That's it from my side.
Thank you.
Thank you. We'll take our next question from the line of Mithun Ashwath from Kiva Advisors. Please go ahead.
Yes, sir. Just wanted to understand, in terms of the balance sheet, how much of land bank do we have directly under Raymond? Because I think about 12 to 15 months back, you did some value unlocking of the land, but that was in a subsidiary of Raymond. And that money was utilized through a rights issue where you subscribe. So I just wanted to understand what is the land bank that you have. Are you looking to monetize anything which is directly in Raymond to bring down the debt further? So if you could.
No, absolutely. I think what you have picked up on is absolutely correct. The focus has been a deleveraging of this company, which has been very well demonstrated during the quarter. Be it the cash flow from the operations, be it a monetization of the assets. We are very clear on this path. Now, to give a perspective, this big Thane, what we have is a 120 acre land which belongs to in this campus, of which 20 acres is to the school. So that is the piece of land which does not belong into the payment. The 20 acre is to the school. And in this 100 acre, we sold 20 acre. We are constructing this real estate project of affordable and the premium and so on and so forth. And the balance 80 acres is something which we have the ability to monetize over a period of time.
Okay. Would you maybe sell a portion of that, or you would want to execute all that 80 acres yourself?
So as I said, we have demonstrated by doing both that we sold the 20 acre, brought the money into the company after payment of taxes and whatnot. So we have done one by monetization of the land itself. The second piece, considering the project which I just explained is going to deliver me 25% of the profit of the project, which enables me to deliver a significant revenue. That is another piece, the way we are willing or pursuing the path of monetization. Plus, we are happy to consider both the options if somebody walks in. But at this juncture, just coming out of the COVID, I see very difficult chance that somebody walking in and buying the piece of land. But we continuously evaluate and review all the options available to us. We will not leave any stone unturned in terms of deleveraging the business.
Right. One question on your FMCG business. Is there any thought of bringing that into or merging it with Raymond so that when the demerger happens, the real estate and the other subsidiaries businesses will be in that, and obviously you will have the textiles in the lifestyle business. I just wanted some thoughts on that so that, as an investor of Raymond, one is able to reap the rewards of that business as well.
So I think, look, our all businesses are doing fairly well in right. If I look at it, the textile business or the lifestyle business, so to speak, does well for their piece. The FMCG business does well for its own bit. And Raymond, being a 47% shareholder in that, does get the benefit of that. So you as a shareholder will be able to reap the benefit coming out of it. And so tomorrow, if somebody has to bring in that business into Raymond, Raymond has to make a value consideration to the other shareholders. So it is one and the same thing that you pay a value consideration today or you reap the benefits up to that point of time. So very simple for us is that FMCG is a core business for us. Now in FMCG, if I look at it, the recovery, I should have covered that in my script earlier, that FMCG business, we have seen also very phenomenal recovery. In October-December quarter, we have seen reaching these guys into the 82% mark level compared to the pre-COVID levels. So we are building new adjacencies, new products in similar to the distribution base. We have a phenomenal distribution base. I think the core strength for the Raymond Group is the brand, the distribution strength, which ascribes a significant value for the business.
Right. Just one last one on the textile and the lifestyle business. Your company is terribly undervalued compared to your peers. And, obviously you're doing this restructuring also to possibly unlock value. Is there any thought of bringing in a strategic investor like a number of your peers have started to do? And just wanted some thoughts on that and any initiative that you're taking on the digital side and how is that playing out right now?
So on the first one, let me respond and I'll ask Joe to respond on the digital side. So let me tell you, if you do anything of that nature, obviously we will inform you appropriately at any point of time. Our focus, as we can say very clearly, is to demonstrate the recovery in the business by making sure that our reach is right, our product is right, and as you rightly pointed out, the whole thing about the demerger is a value unlock. So you will have one side of the story where you have the branded business, which is the branded textile business, which includes the lifestyle and everything, apparel and everything. And on the other side, you have the businesses, which is the real estate, the tools and engineering, and the equity holding in the FMCG. So that is one thought which we have clearly to unlock the value in a big way. Now I'll ask my colleague Joe, who is the CEO of Lifestyle Business, to give the perspective on the digital side.
Yeah, hi. Joe here. So I think on the digital side, I think it's clearly the new norm for us in the business going forward. As you know, I would say, the new normal. We have taken some very clear initiatives in that direction. The first one is really around the fact of we have traditionally been, a non-digital order booking system. We've actually moved it from physical to almost a digital rendering of samples and shifting into more of a digital swatch books, catalogs, and flip books, which basically gives us a huge ability to monetize this at any point of time and also increase the speed to the market. So this entire digital order booking is something that we had the opportunity to play out during this particular period. The second big thing that we are very keen on is that we clearly understand that the consumers are going a lot more online, especially in our segments. And it's very critical for us to really catapult our business of brick and mortar into a brick and click model, which basically then gives us a big advantage to really reach out to our consumers, whether they are online or offline. So that will be a big initiative for us, especially in the lifestyle business, to reach out and take advantage of our 1,600 plus stores across, as you know, the 600 plus towns. Last but not the least, I think it's the engagement with our consumers. We also revamped our own website, which is called the myraymond.com. We have completely the entire store offerings of our EBO available online, which enables our consumers to come to our sites and pick up the stock without even going to some of our stores. So these are the few initiatives, if I would call, which basically will form the digital backbone of our organization and really take us into a much more stronger and far more closer to our consumers and customers.
Yeah, and just to add, people have been talking about on the retail sector, brick and mortar. I think we have migrated from a brick and mortar to a brick and click. So you click it online and buy or pick up the stuff from the store. So that's a new mantra for us moving forward, making the omni-channel presence, which is very, very unique proposition, which we can provide to the marketplace.
Just one last question. You have taken numerous steps to bring down costs, and there's been significant improvement despite your top line being at 70 or 60% of normal, you have still reported EBITDA margins higher than last year. I just wanted to get a sense, let us say 6 months or out, when we are talking after the June quarter, do you get a sense if we're back to those normal, quarterly run rates of 1,800 crores, which you are doing maybe in September, December of 19, your EBITDA margins are going to be significantly higher. How much of these cost initiatives are permanent in nature? If we can quantify that, I think that would provide a lot of information for investors.
Yeah, I think that's an excellent point. The focus during this period of pandemic has been a lot to introspect and see what kind of a cost is there and what's the way forward for the group to identify and the cost which can be taken out or the way of doing a business can be different. And so we have structurally changed a lot of things. And when you do that, you get a lot of permanent savings. I completely agree that we are not going to have the 30 to 33% reduction which we have talked about that will remain as a permanent saving. However, we feel very comfortable to talk about that, let's say anything in the range of 350 to 400 crore kind of a number we see potentially being there in our business on a going forward basis. Obviously, some inflation here and there will be there, but what I'm saying is that is a kind of structural changes. I'll give you certain examples. We used to call a booking show where we would call maybe 2,000, 3,000 people all across the country, bring them in, take care of their bookings and everything, manual bookings. We have moved completely to a digital. So that saves an enormous cost. The way we are penetrating with our customers, we are the best in the class in terms of having the loyalty. We have got 8 million members with us on the loyalty side. So I am directly talking to the customers. So the way I would go out, make big ads in the newspapers and such things, I'm not saying I will not do that, but it may be a limited. But the way I will reach to my customer is a direct. So I know what my customer wants. So to that extent, there are certain regional offices, sub-offices, rentals. We have identified opportunities that how do we reduce the levels in the organization. We have tried to consolidate a lot of departments, lot of businesses together. There were many small businesses we consolidated together and said, okay, how can one work together, bring synergies, bring efficiencies into the business. So there is a lot of effort, and I think a focus team has been working round the clock in the company in terms of targeting and identifying opportunities. If you look, we had said, I think if I remember right, in the second quarter call, we said 52 crore was our rental savings. We continue to work and we have brought it to 65 crore of rental savings. So there is no stone unturned in terms of identifying, and it's a continuous process.
Okay, great, sir. Thanks so much.
Thank you. Our next question is from the line of Umang Shah from Edelweiss. Please go ahead.
Hi, sir. Good evening. So my first question is, I missed your comment on your demerger plans and where it has reached. So if you could just take me there. And my second question is that out of the total Raymond Lifestyle business, if you could share what is our online portion of sales. So obviously we are trying to go to brick to click. So I just want to understand how much is our success in this quarter at least. The previous quarters would be irrelevant. So
if I talk about the demerger, it is an important part of the evolution of the value unlocking for the group. And what we see is we have got an approval from the stock exchanges, filed the application with the NCLT, but we all know that there have been various offices have temporarily closed, they are not been working. We wanted to have the certain clearances which has not been coming as we speak today. However, we still believe that considering that you have the vaccine in place, things are getting back to normal, we should see that in the next financial year, next fiscal year, we should be able to complete our demerger. And as I said, whenever there is something, we will obviously come back and inform to you accordingly. Now, as far as the online sales, I think we have seen increase, and I will ask Joe to comment on that.
Yeah, I think it's a good question. I think we clearly see Q3 again having the increased trend of the online commerce. So we see almost a 3x versus the first half of the year. So clearly showing there's an acceleration, and we are quite ready for it. And we continue to make our plans, not just in terms of alliances with the online retailers, but also to making sure, as we said, our omni-channel capability and our own websites, which will continue to make sure that a consumer franchise will be exposed to our portfolio online as much as our brick and mortar, which offers the offline presence.
Okay, so anything to quantify? So out of 950 crore of the total Raymond textile business, so I'm including only branded textile, branded apparel and garmenting business, how much would be online sales currently? Maybe 10%, 15%, 50%?
So actually, you see, what happens is we do not go out and disclose the numbers on a channel by channel. We know that, again,
so for the overall company.
I think what is important for us is to see that channel we have been able to penetrate, and I would not call more a typical online, because I believe online is not the criteria. I am looking more at omni criteria. I think for me that is more advantage, because if I follow just online, then I'm one amongst the other. But the way unique opportunity I want to provide to our customer base is that I have the inventory available all across the country. You have, as a customer, can look into that inventory and you can pick up from your next door store. And that is the ability which I have. Not many can provide that, because I am present in 630 cities through the various physical networks. And I have also given an opportunity that if you buy something and you don't want to return it online, you can go and return at my store. So these are some of the new things which we are developing, which we are uniquely positioned.
Okay, perfect. So, just one small another question. So in garmenting business, last quarter our revenue was somewhere close to 190 crore, and this quarter it has gone down to 140 crore. I was assuming that quarter 3 is the strongest for Raymond as a company, but we have seen some degrowth over here. Can you just explain what was this and where are we lagging on this?
Yeah, you're right.
Small question, but
no. So look, for us, every business is very important and very close to our heart. So absolutely very clear. We do watch, but you know that late November onwards, the pandemic impact of the second wave, the way it has hit the US and the European markets, which is our core market for the export segment, has clearly impacted and pushed back. We are ready with certain deliveries, and Japan obviously pushed back our deliveries at the end of the fag end of the quarter. So we could not dispatch. We are ready with such inventories, and actually we are waiting for an opportune time when we get a green signal. We ship out those inventories. So, and we all know that the lockdown this time around is little more severe in that part of the world, and people are very careful. I can tell you the ships standing at the docks in Rotterdam and all have been standing there for 60 days and they have not been unloaded. So it's a little tough environment out there.
Okay, all right. Great. Yeah, thank you so much, sir. Thank you.
Thank you.
Thank you. Our next question is from the line of Raghav Kapoor from Active Alpha. Please go ahead.
Amit, appreciate all your comments on cost rationalization, and you've addressed many of my concerns regarding that. One concern that needs to be addressed is that in your balance sheet, you stated that you own boats and aircrafts worth 30 to 40 crores, depending on which year you booked it. It begs the question why a company like Raymond needs boats and aircrafts. And secondly, what is the running cost expense with regard to these line items?
So look, you are in a branded textile business. For having the brand, you need some ways for advertisement and such things. And that has been the philosophy, that you use some of these things as well. It is not the significant part of it, that some of it is on account of the advertisement, the sales promotion, which you need to take it forward.
what is your running cost for this? Because naturally this should be then included in the advertising expense that you incur.
I would not recall what it is. It must be very small numbers. I would not know that.
So just one recommendation. One recommendation is a corporate governance issue. This always looks and stands out as something which is odd. Recognize you need to do branding and marketing as you suggest, but having these on the balance sheet of the company which investors have invested in tends to raise those flags. So if it's possible to park these elsewhere, I think that will give us all as investors more comfort that the corporate governance is the highest standard.
No, absolutely. We believe in the corporate governance of the highest standards, and very well it is demonstrated. If you see, based on the way we are explaining, operationalizing things, the way the focus has been on the debt reduction, working capital management, that reflects upon everything. Now, these things, one can go out. I'll tell you, there are certain businesses, I'm not talking about the Raymond, who does advertisement in a very, very different manner. Somebody does in a very, very different manner. So it is the choice of the company, the strategy of the company, how one takes forward, and the sales and methodology of this. And these are not new purchases in any case. It has been historically has been there for a very long period of time.
Thank you. We'll take a next question from the line of Mithun Ashwath from Kiva Advisors. Please go ahead.
Yeah. Just one follow-up. It is more only if you are able to answer this. In FY22, do we aspire to maybe come back to FY19 or FY20 sales revenues in the in your larger segments of business? Do you see that happening if there are no impacts of COVID, or have you seen some sort of deterioration in the marketplace itself because of changing consumer habits, or do you just see that this recovery will happen once things normalize? So I just wanted your own internal perspective, because if you are able to achieve FY19-20 revenues, obviously your profits are going to be much higher with these reduced costs. So just wanted your thoughts on that.
No, I think first of all, can I say that we are completely out of uncertainty? In my opinion, the answer is no. We still have certain uncertainty unfolding every day here or there in terms of the COVID impact. Like we thought by September, October, as somebody mentioned about the garmenting business, we really were thinking that October, November, December, we can repeat exactly the same revenue numbers. But unfortunately, because of the severe impact there, which is still continuing as we speak today, has an impact. Can I say in the next 6 months? Hopefully, yes. The vaccination is on its way. The vaccination is already there. People are getting vaccinated. But I think the apprehension which one carries today in terms of really going out and spending time and going to the weddings aggressively, not just the immediate family, the larger group, that is bit still little uncertain. People are a little reluctant. Shall I or shall I not go? So I think that has an impact. And you are absolutely right to say that once, if we take out the impact of the COVID, the way we have restructured the business in terms of the cost and the structural changes on the working capital management, with the fashion we are bringing, the designers which we have got, the way they are bringing the products every day and making not 2 seasons, we are bringing 4 seasons, let's say, even the summer booking which we just are in the process of completing, phenomenal booking. I look at it absolutely phenomenal. So that reflects upon that once you take out the minus the pandemic impact, I think we are poised to get exactly back to the same level. I cannot comment in terms of number crunching, whether it is an FY19 number or an FY20 number, but for the fundamentals which we have been able to achieve today, it gives us a comfort that we can be very well be there. And look, in certain businesses, we have already got it. So that's the confidence I can say. Putting a number would be very, very difficult because, the uncertainty is still, there is an overcast.
Thank you. Our next question is from the line of Ravindra, an individual investor. Please go ahead.
Hello.
Hello.
Hello, sir. How demerger will unlock the value of shareholders?
Oh, so demerger, again, it is very simple. Today, the Raymond is considered as a conglomerate, and based on all the experts like you all who are large investors who have always explained to us that a branded business vis-a-vis a conglomerate, there is a difference in the valuation. So that's one of the...
When will it be? Demerger कब होगा? आपका demerger कब होने वाला है?
So as I mentioned, it will be done in the next financial year.
Okay. Thank you, sir.
Thank you.
Thank you. Anyone who has a question may press star and 1 on their touchtone telephone.
So thank you very much. Really appreciated all of you participating in the Raymond's third quarter earnings call. We look forward talking to you in the next quarter.